this is probably why many of you are here, right? If you're an investor type, you felt the pain, you know all about this chart. It's showing you that in times of crises, which this really is a market crisis, right? A bear market, a lot of things going on around the world geopolitically. Everything sells off. Even asset groups that were supposed to be not correlated with traditional equity investments like the S&P 500 there and the NASDAQ 100 there, they sell off. Even gold, right? That was supposed to be the big hedge. Well, some people thought Bitcoin was going to be the hedge, and it was big, but it wasn't the big hedge, unfortunately. This shows different asset groups. These are cherry picked. I'm sure there's some others that maybe look better or worse. Barclay Hedge Fund Index, top 600 funds. They were not a good hedge, right? They often tend to be very correlated with the equity markets because they're trying to keep up with the equity markets. So emerging markets ETFs, they tend to be correlated. They would have saved you a little bit. They didn't lose as much as the equities. The bonds, good grief, 20-year TLT, not good, right? Lost more than even the NASDAQ. NASDAQ had a super rough year. Then Bitcoin, I mentioned, just got hammered. On average, this broad basket here lost almost 26% last year. So obviously, tough time for most everything. And unfortunately, traditional diversification doesn't protect you. And that's the drum we've been beating for a long time. And I'll continue to beat it because it's true. And not enough people talk about it, especially wealth advisors, just don't do a good job talking about it. And I guess it's because they don't have anything that they can really offer clients, or many of them don't, that can really provide the type of, I guess, hedging or portfolio smoothing benefits that something like auto trading can. So let's go to the next slide, please. This puts it in perspective. Auto trading, which we're going to describe exactly what it is, but at its foundation, for us at least, is we're intraday only. So sort of the secret sauce behind what we do is the fact we decided a long time ago that we didn't need to do anything other than focus on intraday trading, and that it was a superior sort of hedging type of opportunity for us, because intraday is just so different than traditional swing trading and buy and hold investing. And you can see our programs here average well more than 40%. That's not a typo, that's not hypothetical, those are real numbers across our 4 different programs that we'll be talking about today. The combo is sort of our middle of the road program. Typical client has anywhere from, I think, a low of 50,000. I believe the Fox Group will allow you to fund the combo up to maybe 100,000. So we typically recommend 75 or 80,000 as a good starting point. But after fees, all fees, that includes commissions, exchange fees, even the license fee for the program itself. That's how we charge an annual license. And Matt will be talking about that at the end. After all of that, made almost exactly 40% net. Now, one thing I want to point out, larger investors tend to be more conservative, and I know this because I myself consider myself to be very conservative. Don't let these percentages concern you too much. Yes, the more you want to make, the more you typically have to risk. But the way I think about this and the way I've always approached futures is they're leveraged instruments. And depending upon how you do the math, you can come up with a ratio of anywhere from 5 to 10x of how much leverage is being utilized. That's a scary thing, right? Or can be for a passive investor who's just looking to make maybe 7, 8, 10, 12% returns per year. But think of futures this way. There are leveraged instruments that allow you to control a lot more capital. The equivalent in the S&P 500, for example, is about, by my math, about $200,000 worth of equity buying power that we're controlling with each contract, each futures contract that we trade. So you're really getting, and for each futures contract, like our Meta program, you only need 30,000 to get started. So for 30,000, you can control almost 200,000. So don't let the percentages throw you off. What it means is that you have an opportunity to hedge your portfolio with a very small slice of capital. You don't have to sell as much and deal with tax consequences and so on. In the stock market, you can take just a little bit of capital and get huge hedging benefits. So that's the way I like to think about it. And it was a great year in 2022. The conditions that were present last year, we believe, are still present, and we're very optimistic about the coming year. So there are a lot of benefits of intraday trading. Probably the biggest one, or the one that makes it sort of most unique from like a buy and hold investment, is that we're only in the market for a little bit of time, right, each day. So we have no overnight exposure. And in the process, that means that's the good news, right? Because we're able to avoid a lot of the risk that impacts the markets over the 24-hour global period. But how do you make money? Well, you got to make money by the market moving. So when you're in times of turbulence, times of market crises, intraday strategies tend to really excel because we're using these leveraged instruments. And when the markets are moving, we can control our stops, our risk, how much we're risking a given day, while riding the intraday movements, catching the trend days is what we're trying to do. So we can get outsized returns relative to the risk that we're having to take. So what this slide shows you is sort of beyond theory, right? This is the S&P 500 every month in chronological order from February of 2018, it was actually January 2018, until present, that the S&P 500 lost money. So you can see the middle column there, the S&P 500 lost 3.89% and so on. And just this past December lost almost 6%. If you look at the column on the right, the combo, our middle of the ground product, not our best, not our worst, just sort of middle funding wise, you can see its returns on the right. And green means it outperformed the stock market. Doesn't mean it made money, it just means it outperformed it. And I do want to disclose also, the combo program technically has only been live since December of 21. So those last 8 or 9 months are live results. Before that are simulated results. We're very conservative. We do things the right way, but I do want to disclose that. And you can see it's outperformed every month, but you have to look closely. You'll see there was 2 months, August of 2022 and September of 2022 of live trading that we lost money. We just didn't lose as much as the stock market. So down there in the bottom right corner, yep. But most of the times we're going to make money, and almost all the time we're going to outperform. At least that's been the historical case. And not just going back to 2018. We could go back a lot further. I used to do this when we managed money professionally. I took it back to either 2012 or 2013. We had 6 years of history we shared with professional managers, and it was the exact same chart, and it was just as impressive. So we've got edge when the markets are going down, and that's because, as hopefully you've read by now, when the markets are going down, they're getting more volatile, right? The ranges are expanding. You tend to get this bigger moves between high and low as fear and greed interact with market participants. When the markets don't have any fear, when they're just sort of grinding higher, making new highs, like 2017, I think it was 2013 was another year, without looking at my charts, we had these grinding moves higher. I will tell you, that is the one time that intraday trading can struggle, when we're making new highs and grinding higher in the stock market. So we don't typically lose a bunch of money. You just can't, it's hard to make money. So that's the one time, and it's a common question that we get when sort of how much volatility we need. We don't need much, but it needs to do a little bit. Okay. So this environment we're in right now is fantastic. It's probably 3 times higher than we've averaged in my own trading career, 15, 20 years. So this is nirvana, or as close as it gets for us.